Thank you, everyone. So there was a funny headline today that said TechCrunch Disrupt was a group therapy session for Facebook from other investors. And let's kick things off talking about Facebook, the Facebook IPO. At least one of you has a financial stake in Facebook, I believe, so you don't have to answer.
A couple of us.
A couple of you.
Yeah.
So those of you who can answer, was the Facebook IPO a success? Simply put, was it well executed? Did it accomplish what the company needed out of an IPO? That's been something that I've read on a lot of venture blogs recently. I think, Joe.
Sure. I'll put my former operator hat on first. I think it was wildly successful at putting a lot of cash in the bank for Facebook, which is really, in my opinion, the foremost job of the company in terms of making a public offering. It certainly wasn't putting an investor hat on. I don't think it was successful at necessarily making your initial investors excited, your initial public investors excited about being feeling good about the first steps. That's pretty obvious given the decrease in value. But in my opinion, if I were sitting on the inside, the company's raised a gargantuan amount of money, I would chalk that up to success. And I also feel like it's clear that these guys are taking very much the long view. So I love the Warren Buffett quote, which is, in the short term, the stock market is a voting machine, and in the long term, it's a weighing machine. Essentially, sentiment is what rules in the short term, and in the long term, facts rule. And so, we'll see. But I think for the company, very successful.
I think, one thing that's interesting is that Benioff yesterday said that Facebook should have gone public 2 years ago, and my view is the company went public before it went public. Basically, there was already a secondary market being traded of the stock, and whether it's a success or not, the company did very well, as Joe alluded to, and there are not that many large internet companies, and they're one of them, and they've done a great job. And you saw Zuck here yesterday, and he did a great job talking about his plans, and I think that's probably what matters most, because in the long run, investors will get rewarded if the company does well, and it seems like Zuck's on the right path.
I think, just to build on this, I think public market investors have a hard time with uncertainty, and I think if you look at what's happened just in the evolution of the internet space and the shift from desktop to mobile, Facebook is at the forefront of that. And so I think that there are questions people are trying to wrap their heads around with the majority of usage shifting to mobile. What would the business model be? It sort of boils down to that. So I think there are some things that some folks haven't totally sort of grokked yet. And I think one is that Facebook has just a massive amount of inventory, just in terms of close to 1 billion users and huge engagement. I think most people know that. The second thing, though, is they have a sense of persistence around identity. So one challenge on mobile relative to the desktop is on the desktop, users are cookied and behavioral targeting happens, and so there's a way that ads become relevant wherever you are on the desktop. That doesn't happen on mobile. And so actually having persistent identity in the form of a login and a lot of engagement, and also Facebook Connect, is super, super valuable in combination with a lot of inventory. And the last thing that I haven't seen documented very well is that they just have a huge amount of talent that has experience specifically in ad systems and monetization. So if you look at the top 100 people who were at Facebook, a lot of them happen to work at a company called Google, right? And so, and if you look specifically even at the team that's building the ad systems, I know these people, so it's like Gokul Rajaram, who worked on product at Google before. It's Greg Badros, who worked in engineering at Google before. So these are people who have a lot of sophistication in the space. And I guess the last thing is there are other things beyond just ads, payments, what could happen in search that could have a big impact on monetization as well. So I think it's the market has a hard time, with areas that are uncertain and new.
And so the Valley's been going through these growing pains, it feels like, with all of these IPOs, where, the second half of last decade, there was a lot of euphoria about the consumer web, in particular, consumer tech companies. Now, IPO's a reality where we get to actually see what the public thinks about, how we feel, or you guys feel in Silicon Valley. How is that affecting earlier stage companies? Are people coming in with lower valuations as a result of the way some of these IPOs have gone, and the general like sense that it's more difficult, more crowded? Are you seeing lower valuations or any other side effects?
I wouldn't say there's been a massive shift. I think there probably will be a gradual shift. Partially because of the public markets, partially because of liquidity events, right? There hasn't been a lot of M&A. IPOs have not been as successful as people hoped. And so I think that there are a lot of early stage companies that are starting to have problems raising Series A's and Series B's, and entrepreneurs talk to each other and compare notes about what they wish they could have done differently in setting up their seed round or in setting up their A round. And so I think over time things will adjust, but it doesn't seem to be happening very quickly.
David?
I think for us, we're seeing the valuations certainly down in more pockets, but
What are the pockets here?
by pockets I just mean in areas, or sort of anecdotally, we're seeing valuations come down a little bit.
Social startups?
Probably social, or the notion of just getting engaged users and saying, hey, I'm gonna pay wildly for that. I think there's a little bit of sentiment around that that's subdued.
What do you need now to like be impressive to somebody like you? Like 10 million DAU, daily active users?
I mean, it's kind of a joke, but certainly, we're seeing companies that have no funding come in and they have 500,000 users or 500,000 downloads and 200,000, something like 40% actives. But I think part of valuations are down because, I think there's some alligator arms. People they're not as flush with cash, so to speak, but, or don't feel that way. But I think for the really good companies or the coveted companies, I haven't seen any effect on valuations.
I'd say a few things. I think at the seed level, valuations aren't affected by what's going on at the public markets. Exactly. It's like that is just an enormous gulf of time, and so they just really don't have a lot of correlation. I would argue that seed valuations fluctuate much more based upon the ability of seed companies in the previous few months to get Series A funding. And so I think you are seeing currently a downtick in seed valuations, mainly because it's a bit of a feast or famine kind of cycle. A ton of things get funded, valuations go up at the seed level. Many of those things can't get funding at the A level, so that seed valuations are in many ways a lagging indicator of Series A funding.
By the way, for the audience, if you tweet questions just with the TC Disrupt hashtag, I'll be seeing those and trying to incorporate them in here. So tweet with TC Disrupt hashtag, and I'll try to get them in. So let's just moving on. What is exciting to you guys beyond lots of users without any funding? Alfred, you've been an operator in e-commerce for a long time. You've invested in e-commerce lately. The last few years have seen a Birchbox for everything. What do you like these days?
So if you're asking specifically about e-commerce, I think e-commerce is one of the more overinvested areas in the Valley. And like you said, there's a Birchbox for everything, which is actually great for Birchbox's brand, but maybe not great if you're the everything component of it. So for me, we have a lot of partners that are focused on enterprise and consumer and mobile. We're always looking for the next interesting company. We're looking for people who are dent makers. We just changed our website, and one of the things we're looking for are people who want to put a dent in the universe. And it really matters less what you're doing and how you're doing it, but why you're doing it. And I challenge anybody who wants to start a company to know the why of why they're starting a company.
Aileen, go ahead.
Just to build. So I think if we're talking commerce specifically, I do think, there's been a lot of innovation in the area of commerce. Commerce historically, if you look over like the last decade, commerce actually hasn't been a great space to invest in, just because the combination of you have to pay to acquire users, low engagement and low gross margins, and not a great working capital cycle. But there have been a bunch of new models that have come up that have actually twisted that kind of on its head. I think that going forward, there are a few areas that are really interesting in commerce. So one is just marketplaces. We see a lot of innovation in marketplaces. I think the second is what I would call online to offline commerce. So activity that happens online, but then where the transaction then happens in the physical world, I think is the second. And I think the third is there are a new set of services that are just mobile first, services that, we've seen stuff in, booking hotels and taxis and car service and gifts, but there are going to be other new services that are mobile first, that take a slot on your phone, and that deliver some kind of combination of it. They're really useful, and also a little dose of magic that you build a habit around that are kind of new, consumer brands. I think those are all new areas that are emerging.
And I would agree in commerce. I think some of the reaction about commerce maybe being over-invested is also because transactional companies generally, when they go public or when they get valued in a certain way that's often different than audience companies. And so when valuations get kind of a little runaway for later stage commerce companies, I think people who spend a lot of time in commerce get nervous. But I think there's still...
Any examples?
I won't mention anything in particular, but you probably have read about them in TechCrunch. But I think that there's just so much more to be done. And I think my guess is we probably all think similarly that commerce is not just about shoes or cosmetics. It's anything transactional. So it's how you book your doctor's appointment, how you rent a car, how you buy anything where money changes hands. And it's still such a small fraction versus of overall real bricks and mortar commerce. It's like 6 to 8%, and just getting to 10%, probably another $10 to $12 billion in revenue will be generated in the next couple of years, which is kind of the trajectory that it's on. So there's just a ton of real revenue to be generated by transactional companies.
What are you telling? Go ahead.
So I was going to say, and building on that, I mean, for us, when we think about commerce, one of the areas where we're spending a lot of time is, I think, whatever the millennial generation or this new set of users that are really utilizing technology and entering the workforce, I think their worldview is different from even the generation before them, and the way they view consumption of, stuff, services. They value experiences more than owning stuff. More of them live in cities, and I think a lot of that is driving new behavior. And so that's any startup that's focusing on that. That's where we sort of lean in and say.
But, I mean, Alfred, you've been in the middle of this. I mean, you did it at Zappos, and you've been investing in commerce companies, and you're sounding a little bit more pessimistic.
I'm not pessimistic from the standpoint like so Aileen and James and David have talked about all these different models, but I think the overinvestment in the areas of everything related to subscription commerce or to another private sales, I'm more negative in those areas, which is where I'm pointing out. All these new models are very interesting, and you just have to think about it from a completely different perspective. And my advice as an operator, if you want to build a transactional company, because e-commerce is low gross margin, it does have a lot of good traits, as we talked about, which is that it's a huge market. It has low gross margins, so figure out how to be unit economics positive as quickly as possible. Not profitable for the company, but unit economics positive as quickly as possible, and then scale up.
I'll get away from commerce for a second to your broader question.
Go ahead.
I, for whatever reason, have a personal obsession with, I think there's a revolution coming in consumer transportation. It's something I've been thinking about for a while. Obviously,
Driverless cars.
What?
Driverless cars.
Well, I mean, there's all the way from amazing kind of science and technology projects like the driverless cars that drive around Google's campus and 280. But all the way through, I mean, I think in 5 to 10 years, your smartphone will replace your car. You will basically be able to say, I'm here, I want to go there, and a menu of options will be delivered to you. And you see hints of this already, right? I mean, Uber is a fantastic service. You've got services in San Francisco like Sidecar and Lyft. You've got Cabulous and a bunch of other companies trying to make taxis feel more like an on-demand service. And I really think that today, there's a handful of people who are diehards who can give up their car. But you really got to work at it. You don't have a car. But if you're like me, with a family, kids, live in the suburbs, I'm not giving up my car. But I think in 5 years, I will be able to. You got services like relay rides, which allow me to rent somebody else's car. So I just think the notion that your smartphone becomes your mode of transportation will be true in 5 to 10 years at a mass scale. And I'm excited about that opportunity.
Aileen, you have a new fund, Cowboy Ventures.
Yep.
It's early stage. Sometimes it feels like there's a lot of early stage investors out there. I mean, even bloggers are becoming early stage investors these days. So, how are you approaching that? What are you doing differently? What are you
Well, I
What's
think
your angle
one of the
for
great
getting in?
things about seed stage investing is generally you want there to be kind of a village around your company. You don't just want one investor. Seed stage investing is really collaborative, and I'm pretty psyched to be a seed stage investor because I have great relationships with a lot of the people here. And like when you're a Series A or Series B investor, the traditional firms are usually trying to get as much ownership as they can. So a lot of the firms are like they don't want co-investors. So I think you want to assemble like a great team of investors, both individuals and institutional angels that bring different perspectives to the table. And so I think, and also you don't need as much capital as you used to launch a product. So
But at the same time, the issue you guys were talking about before is that all of these seed stage companies have gotten tons of funding. Now they're trying to do Series A's and B's, and they're having trouble. I mean, that seems like it would give a lot of leverage back to VCs who do those kind of rounds compared to previous years. Is that right?
I don't know if there is a lot of leverage. Look, the entrepreneur has leverage. You have a great company, we all want in.
Yeah.
Like if any of you guys are building a great, awesome company, we all want in on. And I would focus less on whether we're in the money because it's not about investing. You're trying to find a business partner for your company. And it depends on what you're looking for, and different firms and different people from those firms offer different things, and you should think about that first and foremost. And the second piece of advice is I've actually seen some companies who've raised large rounds, and that seemed like a good idea at the time. I've also seen companies where they've raised those rounds and they come for a Series A, and they still have all that money in the bank. So think 2 or 3 steps out of whether you need that amount of money. Like Aileen said, it's a lot cheaper to start a company today. And so think a few steps out on how you want to raise your money and your rounds and who you want in the syndicate, because I think that will help the company in the long run.
So the venture industry is changing quite a bit. There's been a lot of turmoil, in the Valley lately around these various seed stage entities. There was the debate that Google Ventures got into more kind of with YC about convertible notes. A lot of people have strong opinions about convertible notes. Let's talk about that real quick. What are you guys advising startups who you're talking to? Do you just agree on a valuation and go with it and just sort of live with whatever that is? What are you advising people now?
We don't advise people away from or to convertible notes. We'll do, at the seed stage, we'll do price seed rounds, we'll do convertible notes. So I think for us, that's really a mechanical function. The bigger issue is, do we like the company, the entrepreneur, and do they like us? And do we think the product they're working on is interesting? So I have no bone to pick with convertible debt, and I certainly, we do price rounds and convertible debt both.
But it's causing problems for companies down the road sometimes, right? I mean, especially companies who have raised a bunch of money.
Well, I think what happens is companies over-raise in their seed rounds is part of the problem, and then they get a weird cap table come Series A, and they realize they've diluted themselves more than they think they should. And I think over-raising is generally a risk. It happens because I understand it as a former entrepreneur. When people are stepping up and wanting to hand you money, the temptation is absolutely to take it because you're worried that there may not be other chances to get that money. At the same time, I think it's counterproductive in 2 ways. One is that you really got to think about what your cap table is going to look like with a Series A investor who wants to come in and probably has target ownership of 20, 25%. The second issue has to do with companies that over-raise, and this happened to me personally. I took more money in my second company than I wanted to in the Series A round originally that I was targeting. You say, oh, I'm going to wall it off. I'm going to pretend like I don't have it. I'm going to act like I only have half that money. Never true. Never true. You can't do it.
I have a different view on this. Or put a different way, I disagree.
But I love you.
Yeah. So I think that I think in general, raising more money is better than raising less money, and cash sooner is better than cash later for companies. Because the reality is, for startups, the biggest risk of a startup, like the reason startups die, is they run out of money. That's the number one mortality factor. And so I think that the risk is. I think it's asymmetric, where sure there's a risk that you raise a little bit too much money and then you spend it unwisely. I think that's actually less of a risk than the risk that you don't raise enough and you're not able to actually fulfill the vision you have for the business.
That's interesting. I'm not sure I would fully agree that the number one death factor for companies is that they run out of money. I think that's the effect, not necessarily the cause. Like at the end of a company's life, they have no money. So by definition, they die when they run out of money. But I'm not sure it's causal. I actually think what I would call the good idea fairy is one of the things that actually kills a lot of companies, which is entrepreneurs are natural optimists. We all are natural optimists. And so many of them don't actually complete the thing that they were originally trying. They move on quickly to the next iteration of that idea. They expand the footprint and surface area their company's working on. And money allows them to listen to the good idea fairy on some level.
So just a counterpunch on this would be, I think, you know, that's part of my point, which is actually, if you don't raise sufficient capital, sometimes you don't get to exactly what you need to get to actually prove out the business right away. So sometimes having a little bit more capital to actually be able to iterate once or twice may be better for the entrepreneur than the leap of faith that their investors are just going to support them because they're going to see what's around the corner. So.
I was going to say, I think it's a false debate. I don't think convertible notes are good, convertible notes are bad. I think, you know, every investor has a different business model. And for some investors, convertible notes just don't work for their fund and what they're trying to do.
Which
for
investors do you
And
mean?
for some investors, excuse me?
Explain that a little bit more.
Well, some investors will say, hey, it's important for me that I get actively involved in a company, that I take a board seat, and that I
So that's a
own
venture,
X% of the company.
a venture investor.
It could be a venture investor, it could be a seed investor, it could be an angel investor. And that's where I think it's important for the founder to tease that out. Is there alignment? And the structure, the valuation discussion will all flow from that. So I don't think it's a debate there's really nothing to debate.
I think the debate is more about
it's
uncapped notes
yeah.
versus cap notes, because cap note is effectively a price.
I just think there's too much focus, probably on both sides of the table, on the terms and structuring the terms. I think the bigger point is what Alfred was talking about earlier, which is, like when I choose to invest in a company, it's a long-term decision. Like I'm going to be involved in this company for a long time. When an entrepreneur chooses to actually get us involved, it's a long-term decision. So it's not like we're hooking up. Like we're getting married, you know, and so I think that's a much bigger. So the biggest mistakes I've made when I haven't invested in companies is when I've actually thought, you know, it was a little too expensive, or I didn't like some element of the terms. That's not the most important thing. Is like, is this something? Are these people and is this mission something you want to be a part of?
I mean,
it's the same thing for the investor.
I hear a lot from younger, like, you know, especially first-time entrepreneurs who have a cool product, or they have a good team and they're building a lot of belief in them among investors, and they start getting this contest of who can raise the most money and thinking it's just ridiculous.
Yeah,
Like,
that's
really
the thing that's
surprising.
the most ridiculous part. It's that's a false milestone for your company. Just because you're able to raise more money than your friend, or you were able to raise more money at a higher cap than your friend, that is completely a false sense of security. Raise the money that you think you need. Give up as much of the company that you think you need to give up for the right partners. Find the right partners first and foremost. All the other stuff, you'll figure it out. You should understand the terms, because we have sort of met companies where they came in for their Series A and then they did the conversion and they didn't realize that they had already given up 25% of the company when the company was going to convert all the notes. That's something that you should be aware of, but do the right thing for your company by finding the right partners.
So just going back real quickly, so we talked about e-commerce a little bit, you guys, but all of you are investing across the board, you know, right now. What are you most excited by? You know, consumer, maybe it's played out, maybe it's not.
I hope not.
What do you like? Anything?
So
I already mentioned my excitement about transportation, so I'll let others go.
I think Mary Meeker talked about this a little bit in her recent presentation about how there's like this reimagination going on. I do feel I'm pretty psyched about a couple of things, but one, I call it Life 2.0. I just feel like so much stuff that happens in our work lives and on our kind of personal lives is being reinvented and reimagined by cool new technology products and services that make your life more fun, you get better value, more convenient, like easier communications. They can make you a better person. It can enable you to give more gifts, or share more thoughts and connect better with people. I just think that we're at the tip of the iceberg in terms of all these cool new services being built. And the other thing is, I've talked about a little bit before, is I still think that women are still pretty underserved and are still a pretty small component of, I think they're the best users and the best customers for most products. and they're still, I think, kind of not well served by a lot of technology products, and they will be the power users of mobile. I think mobile is where it's at. And so I don't think we even really understand yet what it's going to be like when women are the power users of mobile.
How do you, I mean, so if you're investing in women, female consumers, how do you go about doing that?
Well, I think every company actually wants female consumers. You know, and I think that there are some studies that show that like companies that don't have enough female users they don't grow as fast as companies that have at least 50% female users. I think everybody wants male and female users.
How do you communicate that to an early stage entrepreneur who's maybe not aware of this?
There's a lot of data actually. So I don't think I'm alone in thinking this. I think you just look at Facebook, Twitter, on a lot of the social is such an important fabric of startups now, and women generally, they share more, they comment more, they're more likely to like things and tell other people about it. So if you want to kind of get the flywheel spinning on growth, you want to have women users.
An area I'm excited about, I touched on it really briefly earlier, but is this intersection of payments and advertising and marketing. I think there's a lot happening there. So the most recent investment I made is in a company called CardSpring that we originally did out of our Discovery Fund, and I invested as a Series A. They're basically building an application platform that sits on top of the payment network that enables web applications and mobile applications to actually connect into the payment network. And it just creates a lot of different opportunities. So it touches on this idea that we spend a lot of our time online, but online transactions, online commerce are tiny compared to the volume of transactions that happen in the physical world. And today there's really a disconnect. Like you can't close the loop between what you do online and what happens offline. It's a really significant trend that's going to be enabled through this connection of payments and marketing.
David, you've been doing a lot of sort of like crowd, there's a variety of terms for it, crowd-based, Airbnb is one.
Collaborative consumption.
Collaborative consumption is a big name. What are you seeing right there right now? I know Airbnb is raising a big round right now. I think we're going to have a story on that pretty soon. There's a lot of activity here right now. A lot of money is still going into it. What is there left to do that you think is most exciting?
I think we define it very broadly, so it's not. It could be peer-to-peer commerce. I alluded to the idea of sort of the millennial generation or the 20-somethings viewing their worldview is just different, and how they view consumption is different. Joe talked about consumer transportation. A lot of them live in cities, and they don't own a car. They don't want to own a car. And not only that, they're actually meeting people and developing relationships and friendships through some of these services, through these shared experiences. So I actually think that's pretty profound, and that can affect. So it's hard for me to say, hey, this is the one area where I think it's really going to take off, but it's really affecting, I think building something on a community is different from building something on a social graph. And that to us is something that we're seeing more and more founders try to leverage.
You're going to see more companies in the intersection of content, commerce, and community pulling it all together.
What's a good example of that?
I think House is a good example of that. Airbnb is a good example of that. The photos as content, and it's a community of people trying to bring together consumption in a different way. And I think there's a lot that can be done in social commerce that hasn't been done before. So shopping offline is still a very, very different experience than shopping online.
What about hardware? Because Kickstarter obviously is a huge place for hardware. There's a few articles that have come out. We're responsible for some of them about how hardware is coming back in Silicon Valley. Is there any venture investment to be made in that these days? Or is it just Kickstarter and seed stage funding? Are you investing in hardware?
We're investors in Jawbone, so we do believe in smart devices and smart hardware and accessories of all kinds. And I think you're going to see more of it. There's a greater maker community now than ever before, and I think there are some interesting things that are going to come out of that.
We also define it broadly in that, I think 5 years ago, like 5% of our portfolio was mobile, and now 30% or probably 40%. Probably in our portfolio, maybe 5%. Probably, 3 years ago, 5% had a hardware component, and now maybe 20%. If you think about companies like Square, Jawbone, even this Nike bracelet, I think you can hack hardware with software, and you're seeing really smart founders do that. If you think about Square, that's something that would be hard to make 5 or 6 years ago.
Anyone else doing hardware?
But I do think payments is going to be a fascinating area. With you've got Google, you've got Apple, you've got eBay, you've got
But
Amazon.
what's left?
Like,
I mean, in payments.
the stakes are really large.
Now, right?
And in the next 3 years, I think there's a decent chance that we won't have to bring our wallets places anymore. It's going to be cool.
Cool. Well, we're over time, guys. So give them a big hand. Thank you very much.